All right, let's talk about a really powerful option strategy. What if you could bet on a stock making a huge move, even if you weren't totally sure which way it was going to go? Today, we're going to dive into a clever play for traders who feel like a storm is brewing and want to profit from it, but with a really interesting twist. So let's paint a picture here. You're watching a company and you're just convinced a massive price move is right around the corner. But you've got this nagging feeling, a little hunch that the news is probably going to be bad and the move is more likely to be down than up. So how do you play that? It's a classic trader's dilemma. I mean, this exact scenario, it pops up all the time. Think about big events like an earnings announcement or maybe a major product launch. You're not just betting on a direction, you're betting on volatility itself. But you want to put a thumb on the scale, and that calls for a specialized tool, not something from your standard playbook. And that specialized tool is exactly what we're talking about today. It's called the strip option. The best way to think about it is as your weighted bet on volatility. It's tailor-made for this exact situation, where you're expecting a huge price swing, but you're leaning bearish. So what is it really? Well, here's the core of it. A strip option is technically a market-neutral strategy. That means you can profit from a big move in either direction. But, and this is the absolute key, it has a built-in bearish bias. It's designed to give you supercharged profits if the price falls. Now, you might be thinking, hey, this kind of sounds like a regular straddle, which, also bets on volatility, and if you are, you're on the right track. But there's a critical difference. A straddle is perfectly balanced. It gives you the same profit potential whether the stock goes up or down. A strip, though, it's asymmetrical. It's built to give you way more firepower if the stock goes down. So how do you actually build one of these things? You might think it's going to be complicated, but really, the structure is surprisingly simple. It only takes 2 steps. Okay, here's how you do it. Step 1, you buy one at-the-money call option. And at-the-money just means the option's strike price is right there at the stock's current price. Then, step 2, you buy 2 at-the-money put options. The most important thing here is that all 3 of these options, the 1 call and the 2 puts, have to be for the same stock with the exact same strike price and the same expiration date. Let's put some real numbers on this to make it super clear. Imagine a stock is trading at $100. So you buy 1 call with a $100 strike for $6. Then you buy 2 puts with that same $100 strike and they cost $7 each. So that's $6 plus $14 for the puts, which brings your total cost to get into the trade, your net debit, to $20. That $20 is the absolute most you're risking. Okay, so we've paid our $20, we're in the trade. Now for the most important part of any strategy, understanding exactly where this position makes money and where it loses. Let's break down the profit and loss profile. Every trade has its break-even points, right? The lines in the sand. For the strip, there are 2. The upper one is simple. It's just the strike price plus the total cost. So $100 plus our $20 cost gives us $120. Now the lower break-even is different. It's the strike price minus half the total cost. So $100 minus $10, which is half of our $20 cost, gets us to $90. Your position is profitable if the stock closes anywhere outside of that $90 to $120 range. And this is where you really see the power of this thing. Check it out. If the stock rockets up to $140, you make a solid $20 profit. Nice. If it only moves a little, say to $110, you lose $10 because it didn't move enough to cover your cost. But look what happens if it crashes down to $60. Your profit is a massive $60. See that bearish bias in action? It's incredible. This right here, this is the whole engine of the strategy. On the upside, you make $1 for every dollar the stock moves above your break-even. But on the downside, because you own those 2 put options, you make $2 for every single dollar it drops below your break-even point. That's the firepower we were talking about. And what about risk? Well, one of the best things about this strategy is your risk is perfectly defined from the start. The absolute most you can ever lose is the $20 you paid to get into the trade. That's it. Your loss is capped, but your potential profit is theoretically unlimited. So now that we see how it works, the million-dollar question is, when do you actually use it? I mean, this isn't an everyday kind of strategy. It really shines under very specific market conditions. So what are we looking for? Think about those huge make or break moments. A company about to announce quarterly earnings that could be amazing or a total disaster. Or maybe a biotech firm waiting on the results of a critical drug trial. These are events with massive uncertainty and the potential for a huge move, the absolute perfect environment for a strip. Now, here's a really important thing to remember. This is a tactical, short-term play. Because you're buying 3 options, you're paying a lot of premium. And that premium is like a melting ice cube. It's subject to something called time decay. So the longer you hold the position, the more value it loses. It's just not built for long-term holds.
You know, this quote from our source material just nails it. It really summarizes the whole thing perfectly. The strip option is for the trader who sees a big move on the horizon but has a calculated hunch that the path of greater probability and, of course, greater profit is to the downside.
And that kind of leaves us with a final thought to chew on. As traders, we often get so focused on picking the right direction, up or down. But strategies like the strip option force us to ask a totally different and maybe even a more powerful question. When is a smart bet on pure uncertainty a wiser play than a simple bet on direction?